This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Rick back on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Rick's picture saying looking for the downloads.
Patrick, let's kick this off with the S&P 500. What's the driver for the whipsaw that we saw in the S&P chart on Wednesday? And is this market finally starting to roll over?
Well, Eric, last week we talked about that this is the pig in the python moment for corporate earnings, as we have four of the Mag 7s literally reporting within 24 hours of each other, and they didn't disappoint in terms of an impact on the market. Well, at least now at the time of recording, we've gotten Microsoft and Meta's earnings, which were decisive beats, and having each of them gap beyond one standard deviation of what was priced into the options market. This has clearly spurred the S&P 500 to have a gap higher and attempting once again to make a higher high. This rally has been relentless. We have now been 100 days above a 20-period moving average, which is rare. It doesn't happen very often that we have that kind of a sustained move without a correction coming. At some juncture, there will be a correction, but there is zero evidence that one has begun. Right now, there are measured moves that target this 6,500 and 6,600 level up above. There's no reason at this moment, unless there's a huge miss by Amazon and Apple, for this to not finish a short-term move on the upside. That doesn't change the fact that the asymmetry is quite skewed against the bulls. Point is that the trend is your friend. It's been working, and certainly those that are invested continue to be rewarded for pressing this trade. The point I want to speak to here is that the bulls that have been invested in this market are being very well rewarded for continuing to press the longs. But deploying brand new money up here does have bad asymmetry. At some stage, we are going to get heavy and toppy in this market. That doesn't necessarily mean that some big bearish breakdown has to occur. The most common thing to happen off of a bull run like this is a typical 5% correction. At this stage, that would result in about a 300 S&P point pullback. Many of these types of pullbacks last about a week or two and then resume back to retest the highs. So even though a correction is overdue, more often than not, it's not a shortable opportunity unless you're a day trader. And at this stage, it really comes down to there's not much reason to panic out of long positions, but it's certainly a bad trade to keep doubling down and adding to positions up along these highs without a correction to buy the dip on. Overall, there will inevitably be a topping formation and at some stage a much deeper and more pronounced market correction. But often topping formations can take months, and the fact that we haven't even begun one means that odds are that throughout the summer the market is going to be contained to these upper levels, and that more ominous stuff is really going to be more likely a fourth quarter story at this stage. Obviously, are going to be looking at things like the Fed rate cut out in September and other types of trigger points. But right now, the only thing I think that could short-term take the wind out of the sails of this market would be a huge jobs numbers miss. But that we'll find out on Friday. All right, Eric, let's move on to the U.S. dollar. What are your thoughts?
Well, Patrick, overall, I'm still structurally bearish the U.S. dollar. But as I've been saying, we need to watch for a counter-trend rally, which frankly is overdue at this point, and we're starting to see signs that it's finally arrived. So this could have legs, but just consider the context here. We're getting excited that we're up to high numbers on the Dixie of 99 point something. It's still less than 100, and we're thinking of it as a high number now. So this could have legs. We could get back into the low hundreds. I think probably staying below 104. How much upside is there? I really don't have a target, but I am convinced it's a counter-trend rally. The major trend is still down. The final low for the Dixie is not in yet.
Well, Eric, I've been pretty consistent with my members about the fact that this is a very crowded trade and that often the pain trade is for there to be a short squeeze to shake out all of those high conviction traders. At this stage, the fact that the dollar didn't make a lower low on that last dip, and now we have the first close above the 50-day moving average in 150 days. The fact that we now have seen a higher low and a higher high and such a rapid rise in the dollar, it is something that needs to be watched because short squeezes tend to be fast and violent. There would be nothing gradual if this did materialize into that. What makes my conviction that we're in the middle of a short squeeze that much stronger is that when you go to the individual pairings of the different currency crosses, you can see a distinct breakdown in the euro, topping formation in the pound, a sequence of consolidation and a break to higher highs in the yen, the Canadian dollar breaking out of a sideways multi-month trade range after a very strong drop in the US dollar against the CAD. All these different cross currencies are all setting up for a US dollar rise. And so the idea here that the dollar index can shock everyone with a move up to 102 to 103 on the upside in a very rapid fashion is something that is really on the table. Now, the one thing I want to highlight is there doesn't have to be a fundamental reason behind a short squeeze. It is a flows thing. It's a situation where the trade was crowded and simply over leveraged. And the thing that I want to watch here is that if we did get one of these short squeezes and the fundamentals didn't pivot, that might actually be another opportunity to go short the dollar once one of these squeezes gets underway. So this to me is a tactical trade for the upside of the dollar and not a big fundamental one. All right, Eric, let's move on to crude oil.
My time spread trade continues to perform extremely well despite the weak flat price. I don't have any directional trade on, but boy, I do have big respect for Rick, so I'm going to think seriously about the comments that he made in favor of a longer-term, long directional position. That certainly is favored or gets a tailwind from the structural backwardation in the market, which seems persistent and has been persistent even in the face of the price dips that we've seen. So I'll keep thinking about that one and maybe give you an update next week. But for now, it's just a time spread trade that I have on.
So, Eric, on page 4, I have the crude oil chart, and I highlighted in a box the 7-month trade range crude oil spent from September 2024 to March of this year in a sideways trade range that defined the bottom end range in the $66, $67 area and the upper range up towards $80 a barrel. Now, the breakdown that we saw in April came at the same time as there was huge turmoil in the markets, uncertainty about tariffs, and more importantly, real genuine risk of recession and a downturn in the economy. That has all subsided and everything is normalized. In my mind, crude oil doesn't belong down in the mid-50s. And so when we consolidated here in the $65, $66 range, it is likely in my mind that this is going to be the bottom end of the trade range as the crude oil market goes back and starts trading in the trade range that it was in the prior 7 months to that breakdown. And so I think we have a situation where crude oil can trade even back up towards $80 on the upper boundary and then bounce around in this trade range for the rest of the year. Generally, I think that there's room for crude oil to be in some form of a short-term bull trend as it approaches those upper ranges. All right, Eric, let's move on to gold and really size up the way that the volatility has been trading in the last week.
Patrick, 3,300 is the must-hold level for this symmetrical triangle pattern, and it didn't hold as of Wednesday's close. Now, it's always possible, you can sometimes have a bad close. It turns out that it was a fake break. It recovers overnight. Turns out it was a false breakdown, and it's all better by morning. If that's going to happen, it has to happen pretty darned quickly here, because it looks like we're seeing the beginning of a breakdown below 3,300. That could very well beget more selling and accelerate the downside. Next obvious stop would be 31.27, and then 3,000 would be the next downside target below that. I think all indications we're seeing are that unless there is a stick save that gets us back above 3,300 so that we can stay there above 3,300, if that doesn't happen in the next day or so, I think 3,000 is probably in play as a downside risk scenario for a deeper correction. So let's see where this goes. I think the dollar rally is driving a lot of it. So how far we can go up on the dollar probably determines how far we can go down on gold. But a deeper correction looks like it's in the cards. We'll see what happens.
It is very interesting, Eric, to watch gold pair pivoting. All year, we've been above the 50-day moving average, and higher low sequences have been persistently going. We've now been in this horizontal triangle pattern, which I drew out on the chart on page 5, and we went and tested the upper range. We were entertaining the idea that that could have led to a bull breakout like we've seen in many of the past triangle patterns, but gold directly tested that upper trend line and directly failed and traded right back down to the June low. The catch here is that this is now the first sustained period below the 50-day moving average since the start of the year. Now, the other part that has to be considered is that the U.S. dollar is breaking out. So we're seeing almost all cross currencies against that U.S. dollar declining. And if you observe that gold has often traded like the cross currency to the U.S. dollar, then if the U.S. dollar is in some sort of a short squeeze and rise, maybe that becomes the backdrop from which gold is going to do a bigger or deeper correction. Now, the Fibonacci retracement of the entire year rally is back down to 3,000. Now, that to me isn't a new bear market. That wouldn't be something that would be devastating, but maybe, just maybe, we could see still a several hundred points to the downside of gold for the next buying opportunity. Overall, to keep this very simple, if the U.S. dollar continues to rise and we see gold remain below this 50-day moving average, we have to accept that some sort of a correction of the rally from the first 7 months of the year may be underway, and then we'd have to evaluate where and how low it will go before we see the next bull trend resume. All right, Eric, let's move on to uranium.
Patrick, this is playing out very much as I expected. We are getting the consolidation pullback that everybody expected. It's just that it's only about 2 or 3%. And to my eye, trying to trade in and out to catch the smaller moves in a market like this is crazy. I don't want to risk losing my position. Now, there is one reason to expect a deeper correction here that's very reliable, even more reliable than technical and fundamental analysis combined. That reason, Eric just abandoned my previous plan to scale in systematically through August 15. I said, screw it. I don't want to miss this market. And I just went ahead and put on my full max risk long position in both uranium mining shares and call spreads on the URA ETF. So I put the last of my long position on the dip on Monday. Of course, the market loves to embarrass as many people as possible. So after I went all in, put on my max risk position, and then said so on the air, the market is probably going to humiliate me with a deeper correction between now and Labor Day. But that's fine with me. My bullish conviction couldn't be stronger in the intermediate to long term. If we take a bigger dip here and I lose a few bucks, I'll make it all back as this comes back. I really think it would take a bigger than Fukushima-sized nuclear plant accident to derail derail this nuclear renaissance at this point, and the market hasn't even begun to price in what's coming. So I couldn't be more bullish, but there's definitely a risk period between now and Labor Day that we could see some consolidation and pullback. And, as I said, I've just jinxed it by telling you that I jumped the gun and put my full position on. So we'll see what happens.
Well, the equities have been rock and rolling, and that trend continues. But I like to focus here on looking at that physical uranium trust. And what we've had is a consolidation after a really nice bull breakout. Now, overall, we've been in a one-year bear market since the start of 2024, and it's really showing all the signs that that bear market is over. Now, with this dip in uranium prices, if this overall holds a line around these support lines and begins to bull higher from here, that would be a tactical new buying opportunity, looking for a further advance back towards even September's highs from last year. We can't talk futures without pulling up this copper chart. Let's talk about what happened here.
Well, Patrick, I've said this before, but I can't say it strongly enough. The lesson that traders should take to heart from Wednesday's record slaughter in the copper market is that President Trump and Secretary Bessent are not concerned about the collateral damage that their policy initiatives are going to cause in financial markets. So that means we should expect more crazy vol events like Wednesday's crash in copper prices on the back of whatever the next Trump policy initiative turns out to be. Is that going to be market positive, market negative? Well, the only thing that we know for sure is all indications are that they're not going to give us any forward guidance or warning, and we're going to get shock events in reaction to these new policies. It was dirt simple to see this coming. I told you here on MacroVoices that the stage was set for a full downside retracement of all that upside that we saw in reaction to the tariff announcement. But I also told you that I was not going to take that trade, and the reason was there was just too much policy initiative uncertainty. We don't know what they're going to do next, and it's very clear that they're not going to tell us. So the story that really is different this time, I think, the knee-jerk on this one was down. It sets us up this time. What I said before is when it was a knee-jerk up, I didn't want to try to trade out of that, even though I thought a knee-jerk down was probably coming, because I didn't want to lose my position. Well, now you just got the buy the dip opportunity, if you didn't have a position on already, to buy copper for the longer-term buy and hold. I think this is a fantastic buyable dip here. I will probably be adding to my position, although it's already overweight, and I just got clobbered on this thing Wednesday. I'll probably be adding here just because I think it's an incredible opportunity. So this one is a better opportunity. Other than that, though, nothing's different. We're going to see more knee jerks, not just in copper, but in other markets in reaction to Trump policy announcements, both tariffs and on other things. Brace yourself, put your seatbelt on. I don't know what's coming next, but there's got to be something.
Yeah, Eric, it was very dangerous because the COMEX copper was really diverging from the LME copper out in London, and that's largely because it was almost all driven by tariff risks. What is clear is that Trump is going to be persistently pivoting on all sorts of these headlines, and clearly this is causing some serious volatility here in copper prices. Overall, I don't see this being a material impact on copper equities, but certainly those that are trading the futures markets are experiencing maximum volatility here.
Patrick, before we wrap up this week's show, let's hit that 10-year Treasury note chart.
All right, let's talk interest rates. We have year-to-date a trade range that's been established between 4% to 4.80. And so we now have a situation where we're virtually trading in the dead center of that trade range in one huge horizontal triangle. The interest rate market has not made its move. You can see as well on the 30-year yield, it also continues to consolidate in a 3-month trade range, but much closer to the upper boundary of the 5 5% yield. What we can see here is that the interest rates have not yet been the wrench that's thrown into the gears of the equity markets. Well, it'll be very interesting to see if we start seeing stress points on the yield markets as we move forward. But as of this moment anyway, we're not seeing the long end moving yet. But what is interesting, I want to highlight here, is that after the FOMC, the probabilities of rate cuts have pivoted. We've gone to now where the September rate cut, which was the highest probability, has now actually pivoted to where it's only about a 43% odds of a rate cut in September and a 56% probability that they leave rates unchanged. And as well, when we go and look at the probabilities of where interest rates will be going out to the end of the year, out on December 10th, one can observe that now the highest probability of over 40% is being priced in at only one rate cut this year and about a 36% probability that there will be two rate cuts. So slowly the market is rebalancing the probability that the Fed moves. What's interesting here on page 12 is I am showing this chart that's showing the rate cut expectations of 2025 versus 2026. And what we can see is that while there is dovish descent in there, that 2026 actually upticked the probability of further lower interest rates, while 2025 had the decline. So what this means essentially is that the market is pricing less likelihood that the Fed is going to move this year, but actually an uptick in the fact that they're probably going to be more aggressive in 2026.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.